options, vertical spreads, and everybody can hear me okay? Excellent. Thanks, Kelly. All right. As usual, we got to take a look at this disclaimer. Everything we do here is for educational purposes only. We are not investment advisors, do not provide investment advice. All statements made here today are the personal opinions of myself and not to be considered any advice to buy or sell any security. All trading and investment decisions are your own and done at your own risk. We got that out of the way. I think everybody here knows who I am, so we will just skip right over this. If you're watching the recording and you want to know about me, just pause it here and read this screen. Okay, so here's our roadmap for today. Like I said, we're going to look at vertical spreads. We are going to do a quick little review, if anybody needs it, on calls, puts, and implied volatility. If anybody wants a refresher on those, just let me know in the chat. Otherwise, we'll blast through that quickly. And anybody who's watching the recording, you can just pause for a sec on some of the slides that I'll show and just review quickly for yourself. Or we might do a super quick review on those for the people who are watching the recording. So why don't we get right into that then? All right, so reviewing what we've gone over before. So call options. Call option is an option contract that gives the owner, that's the buyer of the contract, the right but not the obligation to buy the underlying security, usually a stock, at a specified price, which is called a strike price, for a certain fixed period of time until expiration. For the writer, who is the seller of the call, the contract represents an obligation. Okay, they must sell the underlying security if the option is assigned. That's meaning if the buyer, the person who owns or bought that contract, if they exercised their rights to force the seller to sell them that stock. Does that make sense to everybody? If not, we can back up and we'll go on to puts now. So the put option is basically the same thing, but a little bit of difference. It's an option contract that gives the owner, who's the buyer of the contract, the right but not the obligation to sell the underlying stock. Okay, so that's the difference. Before with the calls, you have the right to buy the stock. Now you have the right to sell the stock. So the right but not the obligation. They don't have to if they don't want to. Sell the underlying stock at a specified price, the strike price, for a certain fixed period of time until expiration. Pretty straightforward, right? Now, if you sold the put option, okay, the contract represents an obligation to buy the underlying stock from the option owner if the option is assigned. That is, if the person who bought that put option from you, if they decide they want to exercise, you have to buy the stock from them. Okay, that should be pretty straightforward. I don't see anybody stopping me here, so we'll keep going. All right, so another little bit of terminology that we should probably review really quickly. Because we'll be using this in today's session. So implied volatility. Implied volatility, also known as IV, in the market refers to the forecasted magnitude or one standard deviation range. And don't worry, we won't get into the whole problems and stat things with standard deviation of a potential movement away from the underlying price in a year's time. So if that underlying price would be whatever that is trading at right now, okay? And we'll show a little bit of an example here. So an example, an option with an implied volatility of 50% is pricing in a move of plus or minus 50% in the underlying security over the next year. All right, so if it's trading at 100 right now, and it's got a 50% volatility, that means it could go to 150 or it could go to 50. That's what's being priced in, that range, over the next year. And in the second session we did with options, I went much deeper into implied volatility, and I showed some little formulas, some quick little math and cheats that you can use to find out if it's got an implied volatility of 50%, how much does it move in a day? How much is it expected to move in a day? So you might want to go back and review that session. So IV usually increases in bearish markets and decreases in bullish markets. And when IV is low, it is best to buy options long. Okay, so and by low I mean, you know, historically low for this stock. Okay, and we've talked about IV rank as well. I believe it was in that second session. When IV is high, it is best to sell options short. Now we can use this to our advantage, right? You know, if IV has never been higher than it is on this stock, then we probably want to be selling options. We certainly don't want to be buying them, because when volatility moves around, it affects the price of the option. Okay. All right. So we are going to learn one new piece of terminology today, and that is the vertical spread. So we'll go and explain what this all means. What is a vertical spread? So vertical spreads use either two call options or two put options with identical expiry dates, but different strike prices in the same underlying security. So say, for instance, maybe we're talking about Tesla. Okay, so we are going to look at one expiry date, right? Both of these have to have the same expiry date, but they'll have different strike prices. And I'll show you how this works in a sec. Vertical spread involves opening a long or buying an option and being short or selling an option simultaneously. Okay, so we're long one option, we're long one strike, and we're short one strike at the same time. So a vertical spread strategy enables traders to limit their downside risk. We can put a floor under our risk. We can know before we enter the trade exactly how much can I lose on this. If you were just to sell an option naked, if it's a call, your downside is unlimited. Okay, so this is why we never sell options naked. Naked call, especially naked calls. Puts not so bad because, you know, a stock can only go to zero, but theoretically a stock could go up to infinity, right? And you don't have infinite money. You know, what if it's a biotech stock and it's like at $5 and they develop a cure for, you know, cure for Alzheimer's, and it's a low float stock. You know, if they are approved by the FDA for a cure that works 100% of the time against Alzheimer's, that stock's going to 1,000. And if it started at 5 and you're short a call on that, you're gonna be down millions and millions of dollars on that call. So that's not a position you want to get into. So never ever sell naked calls. All right. Spreads are the building blocks of more complex options trading strategies, but they work well on their own as well. So what I mean by more complex strategies, you may have heard of strategies like an iron condor or a butterfly or that sort of thing. Those involve putting two different spreads together. Now we won't get into that today. That's a little too advanced for what we're doing. But those strategies, you know, once you get good with just doing spreads, just a regular vertical spread, then you can start thinking about putting the two of them together to create these more complex strategies. Okay, so there are 4 flavors or 4 different kinds of vertical spreads. We'll just quickly, we're going to look at each of these individually, but here they are. So we have the long call vertical spread, and most traders call that a bullish call spread. We have a long put vertical spread, and that's usually known as a bearish put spread. Because normally when you buy puts, you're bearish, right? You buy calls, you're bullish. The short call vertical spread, so that would be a bearish call spread. you know, we're bearish because we're selling this spread, right? We're short the spread. So we're bearish on those calls. And the short put vertical spread is also known as a bullish put spread. Now, I know this might be a little confusing because you're thinking of, okay, puts are bearish. But when we sell a put, then we're actually bullish, right? We're bullish on the stock. I think this will be clear. If it's not already, it'll be clear when we look at these in more detail. So the first one we're going to look at is the bullish call spread. So this is a risk-defined strategy made up of a long and short call at different strikes in the same expiration. So this is best when implied volatility is low, because we are long, right? And we only want to be long when implied volatility is low. So if you look at this profit loss chart, and in case you don't know how a profit loss chart works, okay, on our y-axis here, this is the y-axis on this side, right? This is the amount of profit or loss, okay? And then the x-axis down along the bottom, the horizontal axis, this is the stock price. So as the stock price goes up, we make more money. Oh, that's weird. Why is it doing that? Okay. You know, you can see that as the stock price goes up, we make more money. Makes sense, right? We're bullish. We need the stock price to go up to make money. Now, these little C's here, these are our call strikes. So we have a call strike here, and this price may be $10. And so this is long, it's green. We're long this call strike at $10. And then we're short a call strike at $12, say. Now you can see,
my God.
Hey, I'm just going to mute your cams unless you have a question. If you have a question, and anybody actually, if anybody has a question, feel free to interrupt, type it in the chat, unmute yourself, ask the question. We want to make sure everything's really clear. Okay, so we bought this call down here at 10. We sold this call up here at 12. Now you notice that our profit maxes out. So, you know, way up here is like $20 on this stock, right? But our profit maxes out when this stock goes to 12. And same with our downside. If this stock goes down to, you know, maybe this is $2 way down here, right? Our loss maxes out when we get down to 10. This is what's really cool about spreads. We can be really, really wrong, but we're only going to lose a little bit of money. And, you know, if we owned this stock, you know, if we had bought this stock at $10 and it went all the way down to 2, well, you know, we would have lost $8, right? But here, you know, we're only losing the, you know, the distance here in the option premium, and we'll get into how much premium that'll be in a minute. It's not going to be exactly $2, but you'll see with some more examples later. So does this make sense to everybody? Everybody understands how to read this profit loss chart. If anybody doesn't understand this, stop me now because we've got 3 more of these to go through. Okay, I don't see anybody typing in the chat, so I guess this makes sense. Excellent. Okay, so the next one we have is a bearish put spread. Okay, so it's a risk-defined strategy, like all of these, made up of a long and a short put at different strikes in the same expiration. It's best when implied volatility is low, because essentially we're long puts, right? We're essentially buying puts. So what we're doing here is we are buying a put up here and selling a put here. And we are capping our profit with the sold put, and we're capping our loss with the bought put, with the long put. Okay, makes sense? All right, let's move on to the next one. So this is the bearish call spread. Okay, now it is a risk-defined strategy made up of a long and a short call at different strikes in the same expiration. This is best when implied volatility is high, because it's basically we are net short here on this position. Okay, and that's a great way to capture premium when volatility is high. And if anybody, if you don't understand sort of this, in the previous sessions, I've shown the decision-making matrix. And you can go back, that is actually linked in the session recordings. And you can download this little spreadsheet that shows you, if I'm bullish the stock and I'm bearish, I think volatility is going down, what are the best option strategies? So that's a really handy thing to have. And it sort of explains, which strategies are best when you're bearish on the stock and implied volatility is high. So in this one, we are buying a call up here, and we're selling a call down here. Okay. And then the last one is the bullish put spread. So same as the others, we're buying, we're long and short a put at the same time. And this is also best when implied volatility is high. So we're long a put down here, and we're short a put up here. Is all that clear to everybody? So if it is, we will look at some real examples that I put together yesterday at the close in Tesla. So this is, so one of the ways you can use a vertical spread is to play earnings. As you probably know, earnings are pretty dangerous to play. They're a very binary event. No matter how much you think what's going to happen on earnings, it's quite often a surprise. And if you're just buying or selling the stock, if you're going long the stock or short the stock, you could potentially lose a lot of money. You could also make a lot of money, but there's a lot of risk involved in that. And in my opinion, too much risk. It's not risk defined, right? As a trader, I always want to define my risk. I want to limit my downside. So vertical spreads are a great way to do that. As you've seen, we've been able to limit our downside. Now, unfortunately, we limit our upside as well, but that's kind of the price we pay for reducing our risk. You can, create these strategies so that maybe you don't make a lot of money on each one, but if you keep doing it, if you have positive expectancy, you can do these over and over and over and earn an income from it. So we're going to look at how that might have worked in Tesla yesterday. So if you're going to use a vertical spread as an earnings play, so you want to open spread trades, or sorry, we opened the spread trades that I'm going to show you in a sec at the close prior to earnings. So I'm sure everybody knows that Tesla had earnings yesterday right after the close. Okay, so at the close, went and grabbed a bunch of prices for these options spreads. So yesterday at the close, Tesla's closing price yesterday was $9.77. We are going to use the April 22nd expiration. So at the time, that was 2 days to expiration, right? Thursday, and then expires on Friday, tomorrow. The implied move was about 6%, or, which is close to $60, give or take a little bit. We just need to do really quick, in your head kind of math on these things. All right. So now I got the, you can do the math. I could show you a formula with square roots and everything to do the math on the implied move. But it's way easier to go to this website called optionslam.com and just look at this right here. And we can see, it tells us our next earnings date, which is, yesterday after the close. All right. The implied move on the weekly option that expired or that will expire April 22nd, 5.96%. The implied move on the monthly is 12.69%, and it shows us that expires May 20th. And that website, if you want to just jot this down, is not coming up for me here. Sorry. Here we go. Here we go. Here's that website. So you see optionslam.com, and you just put your ticker symbol in here up at the top right, and it gives you the information you need. So right now we got Cleveland Cliffs in there. We're going to look at that a little later, actually. Okay. So hopefully that makes sense. We need to know these numbers, you know, because this is what the market makers are telling us, that it is likely to happen, that Tesla is likely to move up or down by about 60 bucks or 6%. And generally, if we're playing earnings, we probably want to be inside that range unless we have a really good reason to believe that the market makers have got it wrong. All right. Now, so that means that for Tesla options at the close yesterday, you know, if we had bought them right before the close, because we can't buy them after the close, but we would have bought these right before the close. Our center point, or our at the money option, is 975. Okay. The lower one, you know, 60 bucks below that is 915, and 60 bucks above that is 1035. All right. So you can see that I've used the exact implied move to come up with these strikes. Okay, $60 below at the money and $60 above at the money. All right. Now we don't have to do it this way. I'm just doing it this way, you know, to show you this example. Now next. Okay. There's one more piece of this puzzle. Can anybody tell me what else we need to know, or what else we should know before we open any trades in these Tesla options? There's one more important piece of information. Can anybody tell me what it is? We've already talked about it a little bit. I don't see anybody typing in the chat. Or jumping on it.
Not the data, right? No, because that prevents data, right?
Well, no, the theta in this case, theta is not really going to be that important to us. I mean, we know it's going to decay away a fair little bit, but I mean, we're in this for such a short amount of time because, you know, we're doing this at the close, and we're probably going to close this out tomorrow, shortly after the open. At worst, we're going to be closing it 2 days from now. So yeah, there's going to be some theta decay in this, but it's not terribly relevant. But there is something else that is relevant. And I guess I'll have to give this away.
Give us a hint. Oh, you gave it away.
Yeah. Sorry, I've got a problem with one of my recordings here. Not sure why that's doing that. Huh. That's odd. I apologize. I'm having a little bit of a technical issue here. All right. Well, that's not going to work. I'll have to use the Zoom recording. Okay. Yeah, so this is the implied volatility on Tesla for the last 6 months. Now, this is a little unusual because normally we see implied volatility run up in the couple of weeks before earnings. And we can see that implied volatility didn't really start to move up until a couple of days ago. That's really odd, but you can see it did go up. It went from about, you know, this would have been about 53% up to about 62.5%. So we did see some, you know, we did see a rise in implied volatility, but right now implied volatility is fairly average. So, and you know, while this is usually really important information, it's not telling us a whole lot here, right? It's not really helping us. This is maybe something maybe we might want to dig into a little more. We might want to go over to Market Chameleon that I've showed you guys before, and maybe take a closer look at how this implied volatility is working out. Well, right now, I would say implied volatility is kind of somewhat neutral. So that doesn't help us make a decision on which one of these strategies to go with. However, we do know that implied volatility is going to drop after they release earnings. You know, when we look at implied volatility, or if we looked at implied volatility this morning, we will have seen that implied volatility dropped a little bit. So knowing that implied volatility is dropped or will drop, right? Because it's kind of what it always does, unless the stock goes down a lot, you know, gaps down a ton. We probably want to be sellers of premium, right? Does that make sense? Because, you know, we're gonna play that implied volatility is high, so we want to be selling premium most likely. However, for our example, I'm going to show you guys all 4 of these different flavors and different ways we could have played this. Okay, so here's the first one. This is your bullish call spread, okay? So we are bullish on Tesla. We think that Tesla is going to go up on earnings. And we're not too worried about implied volatility. We think implied volatility is low, or there's not going to be a lot of implied volatility crush on this earnings release. Okay, so we're just going to do a bullish call spread. And this is what this would look like in your option chain. Okay, this one is from Interactive Brokers. And you can see over here on the right are the strike prices. Okay, and you can see this blue here. That is my long strike. So I'm going to buy the 975 call. And that will cost me, or Interactive Brokers thinks it's going to cost me 40 bucks. It should only cost me about 39 or so, right? This midpoint on these. And we're going to sell the 1035 call. And that's we're going to receive $14.60. Okay, so can anybody tell me what this is going to cost? How much do I have to pay to enter this trade? So to do that, to figure out what we have to pay to enter this trade, well, we could just enter it in our system, right? And it'll tell us. But if we take our, you know, we're buying a call for 40 bucks, and then we're selling one for $14.60. So we are actually receiving $14.60. So we can subtract that from our 40 bucks. And we come out with, you know, about 25 bucks, 25.40 to be exact. I think if I did that math right in my head, we'll find out in a sec. Okay, so that's what it's going to cost us. Now I've got the little profit performance graph here, right? So if you remember, down along the bottom, you can see this, right? Here's our stock prices, okay? And over here, they show this on the right. This is our potential profit or loss. Now, the solid line, okay, is what this will be worth at expiration given a certain stock price. And we can see here that our break even is around $1,000. And it tells us right over here, our break even is about $1,000. And you can see, because we've sold that, because we've bought the 975 call, okay, our loss is capped when this goes to 975. Once it goes down to 975, we can't lose any more, no matter how low this goes. Even if Tesla's goes to 0, this, you know, our loss is capped, okay? And the same on the upside. Once we go above our strike, which was 1035, okay, we can't make any more money in this. And if we look over here, so we can see our return for risk is 1.36. Our profit probability is about 40%. Now this tends to be low on IB because it's showing us basically the worst possible prices, not the mid price, okay? It's telling us our max return on this is $3,460 and our max loss is $2,540. And again, those numbers are slightly different because it's using, if this will back up. There we go. And, you know, it's using the ask price when we're buying and the bid price when we're selling. We're not going to do that though, right? Because we're smart traders. We're going to put our order somewhere in the middle here. You know, so we're going to make a little bit more than Interactive Brokers thinks we're going to make. Okay, just waiting for this to move ahead. Good. Okay. So does everything on here make sense? Oh, one thing I think I forgot to mention was this dotted line. This is the profit loss graph at this point in time. Okay. So this is showing you, you know, if, you know, the stock was closed, so nothing would happen. But say you bought this in the middle of the day. You know, if when you had bought this, this is at 977, you know, you've got a tiny bit of loss. If that had shot up right away to 1,025, well, we have already made, you know, $1,000 on that. And that could have happened in Tesla. That can happen in the space of, you know, 20 minutes, right? So you can see how your profit and loss changes, you know, from this moment and then to expiration. It shows here, right? What, you know, what is our minimum investment? That's 2,543, and that includes this $3 commission. But really, the, you know, the number we're interested in here, what's our max loss? 2,540. Our max return is 3,460. Okay, so, you know, not too bad. The probability on this isn't ideal. You know, I probably wouldn't be taking this trade, especially going into earnings, knowing that there's going to be volatility crush. So not my favorite trade here. So what if we're bearish on Tesla? We might want to do a bearish put spread. So to do that, okay, you can see now this is the other side of the option chain. So our strike price is over here on the left now. Okay, so we can see that, you know, we've got the 975, which is basically the at the money strike. Okay, so I'm going to buy that for $38, and this buy here is going to cap my loss, right? And I am going to sell the 915 put, okay, because that's $60 away. That's our market maker move, and I'm going to get 1580 for that. The reality is, though, I'm probably going to be, you know, closer to this mid price, okay? And we can look at the profit loss graph on this. So we can see that if Tesla goes down in price, we will make money. Okay, if it goes up, we lose money, but our loss is capped. Okay, it's capped because of that that long put there. Okay, so our return for risk on this is better than on those calls, right? 1.7 is our return for risk. So we're risking $2,220 for a potential gain of $3,780. Okay. But again, you know, our probability of making money in this is kind of low at 40%. So if we're going to do a trade like this, you know, we want to make sure we're right, you know, probably 60% of the time if this is a trade that we're going to be doing all the time. So that's our bearish put spread. Now things get a little more interesting here. Let's look at the bearish call spread. So do a bearish call spread. Okay, we're going to buy the 975 strike. That's going to cost us $40. We are going to sell the 915 strike, and we are going to collect $75.15. So can anybody tell me, what does this cost us? Anybody?
The difference between the two prices. I can't do the math, though.
Okay. All right, I'll do it for you. We're collecting $75. Let's just call it $75. We're collecting $75 when we sell this 915 call. We are paying $40 to buy this 975 call. All right. So we're actually collecting $35.15. All right. We are being paid $35.15 is going into our account as soon as we make this trade. That's awesome, right? So this is a credit spread. Now the spreads we've looked at so far are what are called debit spreads. They're debits because we pay to put that trade on. We're being paid to put this trade on, so this is a credit spread. All right. Now, you know, you've heard me say don't sell naked calls, right? Well, we're not selling a naked call. We are selling a call, like we have with all of these so far. We're selling this call we're collecting some money, but it's not naked because we have this insurance here. We are long this call as well. And these two will offset each other. If one of these gets exercised, okay, it's protected by the other one. And it gives us a way out. So they're basically just a wash. And we can convert that to cash and, you know, and just take the hit if that was what's happened. Now, occasionally what can happen is one side of this spread might get exercised and the other not. What you need to do is clear that up right away, because you certainly don't want to be naked on the short side. So you've got to fix that up if you are exercised. And I suggest that you don't allow these to be exercised. Okay, you don't let them go through expiration. You make sure you close these right before expiration. Okay, that way you won't run into an issue where you end up, you know, with a naked call short. Okay. So the important thing here is we've just collected, you know, $35.15 on this spread, which I remember, you know, this is multiplied by 100, so this is 3,500 bucks. So what does that look like? Now remember, this is the bearish call spread. Okay, so we want to see Tesla go down, and sure enough, when it goes down, we make money. And, you know, our upside is capped and our downside, our risk is capped. Okay, so our profit probability in this is 59%, but our return for our risk is only 0.62. This is sort of one of the things we have to get used to thinking this way when we're doing spreads. As this profit probability goes up, our return for risk goes down. You know, we're basically we're willing to accept a $3,700 loss to take this $2,300 gain. But the probabilities say we're much more likely to win on this trade. And also, because we're collecting premium here, because I just want to back up. I want to show you, okay, if we look at our short call, right, this is where we're collecting a bunch of premium, is this short call. And if we look way over here on the left, the implied volatility, okay, the implied volatility on that short call is 149%. The implied volatility on the long call is only 136%. Okay, you see the difference in the implied volatility in these. We are selling, you know, so this is what, about 13 volatility points, right? We're essentially selling this volatility. This is great because we know that volatility is going to go down. We're selling something that we know tomorrow when this stock opens and these options start trading, the volatility is going to be worth less tomorrow. There's going to be less of it tomorrow, so that when we have to buy this back, we're making some money off of that volatility. So this is a trade where, you know, we would call this short volatility. Okay, we're selling volatility here, and that can really work to our advantage on earnings plays. Now, if you're long volatility on earnings, that can really hurt you, and that's why they call it volatility crush. All right. Is that pretty clear so far? We'll move on to one more of these credit spreads. Okay, so this is the bullish put spread. Okay, so we're bullish on Tesla, but we want to take advantage of that volatility crush. So we're going to play it this way. And what we're going to do is we're going to buy that 975 call, or sorry, put. We're going to buy the 975 put, and we're going to sell the 6870 put. Okay, so we're going to collect about $30 in premium by doing this. And you can see again here that you know, our differences in the implied volatility. Okay, let's look at the graph on this one. So again, it's bullish, so you know, obviously we're making money as the stock price goes up, even though we're doing a put spread. Okay, and this out of the bunch of these, yeah, this is kind of my favorite trade that we could have done. Now, our return on risk on this is a little bit weak at 1.05. Probability of profit's only 39%. This is, you know, to my eye tells me that this is very incorrect, because it's not your software is not going to be taking volatility crush into account, because that's a bit of an unknown factor. We know that volatility is going to go down. We don't know by how much, so it doesn't work its way into the model here. So our max return on this is $3,070, and we're risking $2,930 to make that. All right. So last chance to ask questions while we're still looking at these things. We're going to take a look and see how we did, because I recorded some numbers in Tesla and all of these spreads, you know, to see how we would have done. Now, if anybody was watching Tesla today, you probably know. In fact, we should actually pull up a chart of Tesla, so we can see what happened. Let's pull up a 5-minute chart here. Okay, so we can see that Tesla closed down here, okay? And here's our after hours and our pre-market. So Tesla closed down here and it gapped up and it opened up in around here, okay? So we had a nice big gap up and it went up for a few minutes, about 15 minutes, and then it started to climb basically, you know, through the entire day until just before the close. So nice big gap up. Any of our bullish spreads should have made money, right? But through the day, the amount of money we would have made on these was sort of declining and bleeding away. So why don't we go back to this and we can take a look and see how all of these would have worked for us. Okay, so what I've done here, I put a little spreadsheet together. This is the trade, you know, that we're looking at here. Obviously, our entry price, and also the price of Tesla, the underlying price of Tesla at the time of entry, which is 977. The implied volatility at the time of entry which was 62.50. And then you can see our recorded prices at 10 o'clock this morning and at the close. Okay, and then I've got our P&Ls on those. So at our entry, the underlying price is 977. The implied volatility was 62.5. Let's look down to the bottom of this, because just for fun, I thought, okay, well, what if we had bought a call, or what if we had bought a put? How would we have done? So yesterday at the close, the 1035 call would have cost us $14.88. At 10 o'clock this morning, that was worth $41.50. Nice gain there, right? 26.62 gain on that. Really good return on that. However, if we had hung on to that into the close, it was only worth $4.25 at the close. So, and we can also see at the close, our implied volatility went down to 55%. Stock price was at 1,009. So it went up, and we see here at 10 o'clock, right? Stock price was 1,073. So by the close, the stock price was at 1,009. At 10 a.m., the implied volatility was 53.1%. So you can see, just, you know, from the close to half an hour after the open the next day, the implied volatility dropped by 10%, or 10 percentage points. Which is actually more than 10% of what implied volatility was, right? So that's a big drop. So it's a good thing that we had some strategies that maybe took advantage of that. Okay, so back to this long call. You know, at 10 o'clock, really nice profit. If we hung on to the close, we actually lost $10.63, right? Which is $1,063, that loss there. Now, if we were long, sorry, did somebody ask a question? Okay, that's not. If we were long that 915 put, it would have cost us $16.35 at 10 o'clock, because, you know, I mean, Tesla had gone up a ton, right? At 10 o'clock, that was only worth 33 cents. And then at the close, it was only worth 34 cents. Basically, we lost $16 on that put. So, you know, put was definitely not the way to go on that. Now, what about our bullish call spread? Okay, so we're bullish the stock, and, you know, we thought volatility doesn't really matter here. So our entry on that was 24.20. At 10 a.m., that had made a really nice gain. Went all the way up to 56.25, which gave us a profit of 32.05 at 10 o'clock. Okay, so you can see that this bullish call spread didn't really get hurt by, you know, by the implied volatility drop too much. Okay, but by the close, this thing was only worth 31.50, right? When, you know, the stock price had gone from 10.73 to 10.09, that was worth 31.58 for a profit of $7.38. So that dropped off a lot. Okay, now what about that bearish put spread? Obviously, this is going to be a loser. Cost us 21.80 at 10 a.m. That was worth 54 cents. Okay, for a loss of 21.26. But because, you know, the stock price is coming down so much, and because it's a spread and not just a naked put, it actually started to increase in value, not a lot, but you know, a little bit by the close, and we would have only lost $18.93. How about our bearish call spread? Now, we received a credit of $40.17 for that. By 10 a.m., this was worth a credit of $59.50. Now, this is what we would have had to pay to buy it back to close it out, right? Okay, we would have had to pay $59.50. Well, we only received $40.17 when we entered the trade, so we have a loss of $19.33 on that. Now, this improved by the close. It was only worth a credit of $52.30, so that's what we would have had to pay to buy it back. So then our loss on that that bearish call spread was down to $12.13. And my favorite out of all of these strategies was the bullish put spread. That cost us $35.19. Okay, at 10 a.m., I could have bought this back for $3.50, giving me a profit of $31.69. I'm a little surprised that this number isn't higher than the P&L number for the bullish call spread. You know, because this should have benefited from that volatility crush. And the reason it didn't, I don't want to get into the details of it, but there's a thing called skew, where the skew between the calls and the puts. And that's why we don't see, you know, our P&L on this put spread higher than the call spread. I think, you know, if there'd been more movement in the stock, then, you know, this would have been to our advantage. We would have been able to take advantage of that volatility crush a little bit. The closing price on this one was a credit of $26.91. And that would have given us a profit of $8.28. And here you can see the volatility crush started working in our favor, right? So whereas that skew was a bit of a problem earlier in the morning, all of that smoothed out by the end, and this worked as it should have by later in the day. And you can see that we would have had a profit of $8.28, whereas the bullish call spread only had a profit of $7.38. And that is the difference, that playing on the side of volatility crush, right? Being long volatility as opposed to being short volatility, how that worked to our advantage here. So does all of this make sense? Was it good to you know, see all of these different strategies laid out like this? And does anybody have any questions? You guys are all so quiet. Okay, I'm going to assume there's no questions. So we
I have one question.
Excellent. Okay.
Is there a wrong way of closing these? Because I don't remember which one I did one time, and I closed it the wrong way or something, and I had to pay, like I owed money. I was in a negative or something.
Right. Yeah, that's something you need to be careful with. And you need to wrap your head around that. And it kind of depends on how your platform works on these things. I suggest you paper trade these so you get a sense for how that works. But to start with, you should really close both sides at the same time. You can close them separately, but you really should close them together. Okay, so keep it together as a spread. Sometimes there are good reasons to close them separately, though. And as you trade these, you'll get a feel for when that is. But for now, when you're new to this, close them together. Okay. So think about what you're doing, right? If you're here, let me back up a little bit here. Let's see, let's go here. So this is the bullish call spread. All right, and you can see that, we're essentially long this, okay? So when we close it, we want to sell it. All right. Now this is not necessarily the way it works in interactive brokers. They make it a little confusing, but I think for most platforms, you're going to be, you're long this spread and you're going to sell it. So, you're -1 or whatever when you enter your trade. Okay. Pretty simple. But if we go to a credit spread, yeah, here we go. The bearish call spread. So this one's a credit spread. Okay. So we need to think that we are short this. So we need to buy this back, okay? So if you're thinking of it that way, I'm short, I need to buy it. I need to replace it. We got a lot here. Sorry, one sec. Okay. So does that make sense, Callie? That, if it was a debit spread, you're going to sell it. If it was a credit spread, you've got to buy it back.
Yeah, it makes sense. I think that was my mistake, that I tried to close one separately, and that's how I messed it up. But yeah, thank you.
Okay, yeah, you're welcome. Now, if you're on interactive brokers, it works a little differently, although you can flip it. There is a way to flip it so that it makes sense with the way I just explained it. On interactive brokers, you still sell it. But you sell it for credit, which if you, I don't want to confuse everybody with this because I'm sort of confusing myself, because it's something I still have to think about every time I do it with interactive brokers because their system is just weird that way. But you've just got to make sure that, are you collecting or paying, when you sell it. Okay, so what did I want to do next? Anybody else have any questions? If not, how would you guys like to see us look at this live? We can go to the option chain live. We can look at a trade. We can set up a trade, all of us together. And hopefully I get some feedback from some of you guys about, what we should do with this particular trade. I think that'd be really useful for everybody. So why don't we do that? I want to look at this stock. Now this stock has earnings tomorrow morning before the open. It's Cleveland Cliffs. These guys are in the steel industry. All right. So, looking at this stock, it has been very bullish. It's in steel. It's got a nice bull flag forming here. So what do you think? Are we for earnings? Now, obviously, we don't know anything about the fundamentals and we're just kind of guessing, right? But just sort of giving off, what we see on the chart with this bull flag and everything. What do you think? Are we bullish or bearish on this stock post earnings? Do we think it's going up or down once they release earnings? Anybody want to throw your ideas in the chat? Just give me a bull or bear on this. All right, Callie's bullish. And nobody else wants to give me any ideas. Okay, well, I'm bullish too, so let's go with, we're bullish on this stock. All right, what else do we need to know about this stock? Well, we need to know what the implied move on this is, right? Oops, that's what I'm looking for. Okay, so the implied move on this on the weekly is 7.26%. I'm just going to write this down. 7.26, and on the monthly, it's 14.76. Okay, so that's the implied move. So let's go to our option chain. And I've got Cleveland Cliffs in here. So I'm looking at the monthly. Now we need to decide, do we want to play, we could play tomorrow's expiration if we wanted to. There'd really be an all or nothing bet here, which they kind of are with earnings anyway, right? But just for fun, let's do the monthly because we did the short duration ones before. Oh, and while we're actually on this page, though, we also want to be aware of what volatility has been doing. And we can see the volatility has been rising. It's at 69.3%. Back over here, it was at 72. So volatility is very high in this. So we want to be sellers of volatility, right? So we're bullish. We want to be sellers of volatility. So what kind of trade do we want to do? Let's go back to take a look and see, what kind of trades we can do in this. Where's our list gone? That's the one I'm looking for. And here. So what do you think, Kelly, what do you think is best? If we're bullish on this stock, we can do the long call vertical spread, the bullish call spread, or we can do a short put vertical spread, the bullish put spread. Which one do you think would be best, Kelly?
The bullish call spread?
Well, but volatility is really high, right?
Okay, yeah.
So the bullish call spread.
So it's the bullish put spread.
Right. So the bullish call spread is best when volatility is low. The volatility, we know the volatility is high, and we know the volatility is going to go down after they release earnings. So you're right. You just said the bullish put spread. Okay.
Because we're selling the volatility, right?
Exactly. We're going to sell some of that high volatility because we know that, volatility is coming down tomorrow. So we're going to make, even if we're wrong, we can still maybe make some money off of selling this volatility. It's certainly going to work in our favor, having sold that volatility. So we're going to do the bullish put spread. This is what it's going to look like. All right. All right, so let's go back over here. So we know this is going to move 7.6%. So what is this thing trading at? So this thing is like 30 bucks. So 30 bucks plus 7.26%. So the market maker says this doesn't go any higher than 37. If we go back to our chart, and if this actually breaks out, above this flag, and remember, we've got a month, right? Oh, sorry, actually the monthly on this is 14.76%. So what's our price right now is about 29.58. So 29.58 plus, we'll call it 15%. So that's about 34 bucks. Okay, so market maker says it goes to 34. Well, look at that. I mean, that's kind of the top of this bull flag. That is kind of resistance, right? So that seems fairly reasonable. So we want to be inside that. So we'll cap our profit at say 34. So going back over here, what that means is I am going to sell the 34 call. All right. and I need to buy one. So what should I buy? I can buy out of the money. That will give us, a better return, okay? But it's going to reduce our odds. If we look at the profile here, where's my profile gone? Oh, it's hiding behind this window. Let me deal with this. Hang on a sec. Sorry, I gotta play around with windows here. There it is. All right. There we go. All right, so this is what the risk reward return looks like on this. Okay, so here's our graph on this. We can see our return for risk is 1.73%. That's not bad. Our profit probability is only 41%. You can see we're risking $220 to make $380. I kind of like this. I wouldn't actually trade this one, but for the purpose of our example, this doesn't look too bad. But why don't we close that and bring this back in and see, look at another one. Maybe if we move this to a little bit in the money, okay, say 31, okay, and see what this looks like. So I'll just have to get this out of the way. And check out our profile, do that. Okay. So on this one, okay, we've really reduced our chances of profit on this, but we've got a much nicer return, okay, at 2.66%, or sorry, 2.66 to 1. We're risking $82 on this to make $218. But again, the chances of making money on this are kind of slim. We got to be really bullish if we're going to go with this one. So I'm not really a fan of that. Do these numbers change if I? No, that didn't work. Whoa. Whoa, didn't like that. Okay. It's coming back now. Sorry, Interactive Brokers was not happy with what I just did there. All right, we just got this back. And wow. Aha. It's coming back to life, but it looks wrong. Okay, so let's go back to this. What was that first one we did? I think we were long in around 27. Why don't we try this? Why don't we go long at 25, the 25 put, okay? And we're going to cap this at 34 because there's a resistance at 34. All right. And we're going to look at the profile on this one. Here we go. Okay. We have brought our chances closest to even on this, okay? So, but we're risking 469 to make 431. Not sure I'm entirely thrilled about that. It probably comes out to about even on that by the time we factor in the midpoint. But yeah, I would rather go with that first one that we looked at. So let's bring that one back up. I think that was the 28. The 28 and the 34. And here we go. There we go. Yeah, the 41% probability. Good return on risk on this one. This is definitely, I think, the trade that we would want to go with. So what we'll do is I'll screen capture these and I'll post these into the options channel. I'll do that tonight when we finish the session. And then tomorrow at the open, or shortly after the open, I'll probably be busy at the open. I'll capture these again so we can see where we're at. You know, what is this worth? We know that right now this is going to cost us. What are we? Sorry, not cost us. This is a credit spread, right? We're receiving money on this. So 440 less, or really not 440, 455 less 56. So we're going to receive a $4 credit for this spread. So I'll make note of that as well. And we'll look and see, how does this work out tomorrow morning? You know, after they release earnings. You know, if their earnings suck and it goes down, obviously this trade is going to lose. But we'll see that, you know, it's only going to lose $220. I wonder if we should do a bearish trade on this as well. Can't hurt, I guess, right? So let me make some notes. So the bull one on this was the 34.28 put spread. Okay. So why don't we do a bearish call spread? Because with a bearish call spread, we can still collect some of that premium, right? The premium on the volatility. So let's take a look and see what that's going to look like. All right, so we'll just clear those out. And why don't we do it the same way? We'll short the 28, or sorry, no, we're going to go the other way on this, don't we? I don't think this is going to be right, but we'll see what this looks like. Yeah, no, I'm not linking the way that works out. What we need to do clear that out. Yeah, we need to go short the 32, or sorry, long 32 and short down here around 24, I think. Yeah, that looks better. And give me a profile on that one. That looks better. Cool. Okay, this is sort of like similar numbers to the other one we were looking at. So this will be our bearish play. We are going to be short the 24 call and long 32 call. All right, we get a return to risk of 1.76. Profit probability on this one is 44%. Max return 510, and our max loss 290. You know, not a bad looking trade if we were bearish on this stock. So we'll keep track of that one for tomorrow as well, and we can see how this does. And, you know, I mean, we could even, because, you know, we've got a, oh, sorry, this is the one that expires tomorrow. Shoot, didn't intend to do that. Oh, well. Yeah, we'll take a look at this in the morning, and we'll take a look at it again in the close, see, you know, how we would have done on this. And I think it'll give you a better feel for how these work. So I think, you know, going forward for you guys, you know, just remember to, you know, play around with your option chain, you know, looking at these numbers, changing these around, you know, and seeing how that affects the, you know, your probability of profit and your return potential and everything. So this one's 32, just making notes here. And I think it was the 24, right? Yeah. Play around with them and, you know, paper trade them. You know, that way, because you're going to make mistakes when you do this. When you start getting into the more complex option strategies, you're going to make occasional mistakes. Don't want to single you out, Callie, but you know, you were kind enough to mention a little mistake you made. It's really common. I've done it, and I've done it more than once too. You know, early on, you got to wrap your head around how to close these things and whatnot. So paper trading these is a really good idea. You know, you can play around with them, see how they work, see how you know, they work the following day, you know, when that stock opens for trading, when the options open for trading, and how that volatility crush works. But this is, you know, if you have to play earnings, this is a much better way to play earnings, you know, rather than just buying a call or buying a put, because it can really, it caps your risk. And you can also put the odds in your favor a little bit by capturing some of that volatility crush. You know, when you're just buying calls or buying puts, you're getting volatility crushed. You're paying that volatility premium to somebody like me who's doing a spread like this, trying to collect that volatility premium. So yeah, we'll go back over here. If anybody has any more questions, this would be a great time to ask them. Otherwise, we're going to start shutting this down. And we'll take a look at what we've got coming up next. So this is everything we've done so far. All these recordings are in the Mentor Session Recordings channel. You can go back and rewatch these if you want. Not sure what we're going to do next time. I'd love to get some feedback from you guys. Shoot me a DM, talk to me in the Discord. Let me know what you want to look at next. I want to, you know, I want to be covering stuff that you guys want to cover. If there's something with options that you're not understanding, you know, maybe next time we should do a big Q&A or something like that, rather than looking at more strategies. You know, I want to give you guys some time to play with these strategies that we've looked at so far. The Greeks, yeah, we've covered some of the Greeks, Callie, here and there, but maybe a session where we go through all of the Greeks again, one by one, and we can cover all of the major Greeks. That's not a bad idea. That's a great session. I'm gonna write that down as one of our suggestions. If anybody else is watching the recording, you know, feel free to chime in. Let me know what you'd like to take a look at. Now, as far as what we've got coming up on Sunday at noon, Nick is doing a fundamental analysis, a bring your ticker. It's going to be kind of like a ticker talk, but with no charts, or he might bring up a chart or two, I don't know. But he's really going to be focusing on the fundamentals. And the important part of this is it's your tickers. So if you want Nick to do a quick fundamental analysis of your tickers, you know, this is a good chance to do that, and he'll look at them live and let you know what he thinks. So very similar to Ticker Talk in that way. I think it would be really cool, and I might show up and fire a ticker or two at him too. So that's all I've got for you today. I want to thank everybody for coming out. Hope you all enjoyed this session, and oh, you're welcome, Kems. And we will see you all again next time. I'll be back on Thursday for Ticker Talk. So I know I'll see some of you there, and enjoy the rest of your night. Thanks, everybody.